Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hello and welcome back to the Investing Podcast. My name is Ben Nye. This is Tusk Media. This is a special recap on Teva Pharmaceuticals. Teva is a drug company. They produce a lot of generic drugs. They also have a specialty pharma division. And they reported earnings last night. Now, the big picture for Teva, kind of looking back a few quarters, even over a year ago, was that they were saying that they have two major divisions, their generic division and their specialty division. And they were seeing that growth in the generics business was relatively weak. So they went ahead and bought Allergan's generic division, and they incorporated that into their business. Now, the deal didn't close until the third quarter of 2016. It took over a year to close because they needed approval from the relevant authorities. So this was the first quarter with those numbers added into Teva, and it didn't look good. The bull case for Teva is that over time, more and more people are going to be buying generic drugs, which creates a rising tide, which is going to lift all the boats, including the biggest boat in the ocean, which is Teva. Teva is the largest generics drug company now in the world. It's an Israeli company. It's been around for a long time. They produce a number of drugs. I'm sure everyone who's watching this has used them, unless they are a member of the Church of Scientology, which I hear does not use drugs. Am I correct, Garrett?
I'm not very familiar with Scientology.
I think I'm right on that. Nevertheless, Teva is a company that everyone is familiar with, even if they don't know it. So the issue for them is a lot of their growth has been due to rising drug prices. People say, well, in generic drugs, you can't have rising drug prices because isn't that just, aren't people going to compete and bring the cost down? But that's not the case. For example, in this latest quarter, Teva generated a 50% gross margin in their generics business. And if you have any business that generates a 50% gross margin, you're doing quite well. A lot of industrial companies, they target more of a 30% gross margin. For another picture of it, even tech companies like Intel, where they have a lot of IP going into it, and a lot of, they have a lot of mental energy into it, have a larger moat with fabrication facilities. They're generating gross margin in the 60% range. So Teva, a generics company, 50% gross margin. So that indicates to you the importance that pricing plays in the generics business. Even greater so in the specialty business. They have their blockbuster MS drug is Copaxone. Copaxone is delivered in two different quantities. It's delivered in 20 milligram doses and 40 milligram doses. And Teva generates almost a 90% gross margin in that business. So extreme pricing power. For every $10 of product they sell, it costs them $1 to make in that business. So if we look at the numbers in detail, the company beat on earnings per share, which means they beat what Wall Street analysts were saying that they would do, and they missed on revenue. So that means they were making a lot of money when you all dropped it down to the bottom line, but their sales to end customers were not as strong as expected. The reason they can do that is, for example, let's say instead of selling $10 of product to a customer and making $8 on it, they're selling $9 of product to a customer and making $8.50 on it. So their margins are better than expected, but their revenue was worse. Part of that was due to a non-GAAP cost of goods sold adjustment of $246 million. In the conference call, an analyst asked, what was the rationale behind this cost of goods sold adjustment? Management did not really explain it on the call. They said it was due to a bunch of different things that they would go into more detail if the analyst followed up with the management after the call was over. Based on my research, it does not seem that cost of goods sold has been adjusted very much in the past. This would be more of a one-time thing that we've seen. So maybe some margin expansion coming from that one-time adjustment, if it is truly one time. In addition, they brought down their revenue guidance for the full year. They say that we're just not getting the approvals that we expected in the third quarter. They expected that they were going to get a lot of approvals in the third quarter and fourth quarter. They're now not expecting those approvals until 2017 or maybe even 2018. So this is a huge push out of their drug pipeline, and one that is not especially good when you consider that they need $500 to $600 million in new product revenue every year in order to keep that cadence of generic drug growth going, because every year they see some pricing erosion. And in fact, pricing erosion was actually higher than expected, which means they were selling drugs for less than they had wanted to. And they say that this is because of the divested drugs that they have. So when they did the merger with Allergan's business, they combined the two businesses, and then they were told by the authorities in the United States, well, if you're going to combine this, we need you to get rid of so many drugs. So Teva divested some of the drugs, and they saw pricing pressure in those segments. Now, Actavis, for the Allergan acquisition for Teva, is proceeding as expected, which means their cost synergies are going as expected. Their accounts payable that they inherited were higher than expected, which means they actually had to pay out more money to suppliers than they had initially thought they would. So on one hand, your cost synergies are doing well, they're in line with your plan, that's good. On the other hand, what you're inheriting is not what you thought you were inheriting. So if I thought I was going to get a product that was an iPhone that was 1 year old, maybe I got an iPhone that was 3 years old. It was similar, but not what I thought I was going to get. So that was bad. And then finally, one of the biggest issues for Teva at the moment is that it's currently under criminal investigation by the DOJ. The Department of Justice is embarking on a criminal investigation of drug price collusion in the generic space, which implicates both Mylan and Teva. And there was not really any more detail on that. And you wouldn't really expect any more detail on that. I mean, what's Teva going to do? They're going to come out and say, we actually colluded on price, we're sorry, we're working for a settlement. No, they're not going to do that, especially not when it's criminal. So give me a break. They're not going to do anything like that. It's going to be a longer process. I'm going to have to see how the new Trump administration plans to go after this, because this is an executive department agenda. So where does that leave Teva? Stock's trading markedly lower today. I had a bit of a, for the accounts, some of the accounts I manage, had a strangle on it, which means I actually owned some underlying shares, and I also had puts. So today, thankfully, I had the puts because they helped insulate me from the loss. And actually, once they start to increase in delta, they become a bigger and bigger portion of the account, and you eventually become short of the stock. So that's what happened today. So I kind of pared that position down. The puts expire at the end of the week. Put options are a decent way of hedging a position if you're nervous about it. The problem with put options is that you do have to pay a premium at the beginning, and then with every day that goes by, you lose money because the put option, which is also based on amount of time until expiration, put option decreases in value. So if you're really worried about a position, you can buy some insurance. Put option can be seen as insurance for that position, but just bear in mind that that insurance decreases every day. It's like at the beginning of the year, you can buy home insurance, and maybe at $1,000, that's reasonable to you. But when you buy a $1,000 home insurance policy, that's only good for one day on December 30th or December 31st. There's a different risk-reward scenario when you look at it that way. So going forward, the path for Teva, very murky. It trades at an exceedingly cheap valuation relative to adjusted earnings per share. If you look at the GAAP, which uses generally accepted accounting principles, it's a more expensive valuation, but a lot of that is due to amortization of the acquisition, which is kind of a cash flow that's already taken place, that's incorporated into the balance sheet, and the amount of interest that it's paying out, as well as the shares outstanding. So adjusted EPS can be a good barometer to gauge the health of a company, but just be wary of what is being actually adjusted in that earnings per share figure. So very cheap stock. Question is, what is the durability of those earnings going forward? Is generics business going to continue to fall? Is the specialty business going to see generic competition with Copaxone? There's a ruling going to be in next February. And what is going to happen with the DOJ? So a lot of uncertainty. Some would argue that uncertainty breeds opportunity. Me personally, I am a fairly risk-averse investor, so I am staying away at the moment. I'm neither buying nor selling any more shares. At this precise time, that could obviously change by the time the video goes up. But at this point in time, I'm taking a hands off. It's a wait and see. I want this story to play out a little more. I want this story to de-risk a little more, because it could really go either way. This has been the Investing Podcast. Catch us back tomorrow. We're going to have some more interesting content relative to the election and kind of what has been the fallout for that. We're also going to review some of the 13F filings from various hedge funds and go through some of the ideas and trends that we're seeing among those portfolios. Thanks. Catch you later.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.